In the standard logic of resource management, the more you have of something, the less impact the next unit usually has. This is the principle of diminishing returns. Yet, in the machinery of global economics, capital defies this intuitive gravity. We are investigating one of the most enduring mysteries of the modern era: why we can keep piling up machines and software without crashing the system. Nicholas Kaldor observes specific patterns that define modern industrial progress. Central to these is the observation that economies do not just grow, they become more capital-intensive. We are constantly providing workers with more sophisticated tools, yet the reward for owning those tools refuses to disappear. The capital-to-labor ratio, expressed as K/L, measures the sheer volume of machinery and infrastructure supporting every individual worker. Since the dawn of the industrial age, this ratio has moved in only one direction: up. For example, a modern farmer is no longer just a laborer with a tool. He is a specialized operator managing a $500,000 GPS-guided harvester.
Standard theory suggests a trap. As you flood an economy with more machines, the return on that capital, the interest rate, or small r, should eventually crash towards zero. However, Kaldor noticed that despite a massive increase in the K/L ratio, the return on capital remains remarkably stable over the long run.
Why does the return on investment stay high? Because we are not just adding more of the same old tools, we are inventing better ones. Innovation shifts the entire production function upward. If you give a tailor 10 manual sewing machines, the 10th one is redundant. But if you give him one automated industrial loom, his productivity and the return on that investment reaches a whole new level.
Historically, Kaldor identified several pillars. First, productivity grows steadily. Second, equipment per worker grows at a similar rate. Third, the real interest rate shows no long-term downward trend. Crucially, his fifth fact states that the shares of national income received by labor and capital remain stable over the long run. While modern data since the 1980s has challenged this constant share, it remains a fundamental theoretical pillar of the growth model.
This creates a powerful cycle. Firms invest in new capital, which increases the K/L ratio. Normally, this would lower profits, but continuous innovation steps in to maintain efficiency. This keeps the return on capital high enough to encourage the next round of investment, fueling the engine of sustained economic growth.